The stock market sold off here today by about 0.5% depending upon the index. And after the 3-day rally that we'd experienced prior to today, we actually saw some of those indices transition back to a weekly bullish intermediate term posture according to the market forecast. However, I don't know how much I trust that posture at this exact moment in time because prices remain below falling 30-day moving averages. So we'll talk about all of that. We'll then get into our trade application example where I wanted to focus on a direct listing stock, and those of course have been all the rage here with Palantir about ready to go public. So I want to talk about a different direct listing whose stock chart really isn't doing much, at least if you're bullish on it. So I wanted to focus on a bearish trade in tonight's video. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's September 29th, 2020. First of all, if you're new, remember to go over to YouTube, click subscribe on our channel, then go to the description area and sign up for our email distribution list so that way you can be alerted whenever we do post these videos. It also gives you the heads up on which stocks within the S&P 500 are giving you overbought and oversold cluster signals. In addition to that, we're heavy users of Twitter. I would encourage you to follow me if you're not doing so already. My handle is @BrandonVanZ. And we do appreciate those of you that click like and retweet on these Market Outlook related tweets. And then lastly, we do have a presence on Facebook as well. Feel free to join our group at the web address you see embedded in the logo in front of you. All right, let's go ahead and jump into our charts here. And as I mentioned in the intro, it was a reasonably quiet day. The markets really didn't do much of anything. S&P 500 was down about 0.5%, as was the Dow Jones. We saw slightly smaller declines out of the NASDAQ and the Russell 2000. You know, it's possible that we're kind of in a little bit of a holding pattern here today after a nice 3-day rally that we've experienced. Plus, I think a lot of people are anticipating the presidential debate tonight to see, you know, if that is going to lean one direction or another and see what that means for stocks. So I think that's going to, you know, potentially open up, you know, the opportunity for some trading tomorrow in individual names that might, you know, either be negatively or positively affected by what we hear this evening. But anyway, with the market movement higher in the last few days, as I mentioned in the intro, we've got a couple of changes I'd like to report for you. And that is up here at the top, the S&P 500 and the Dow Jones Industrial Average, you'll notice, went back to that weekly bullish intermediate posture here today. Yesterday we had that dark pink background color. Today we transitioned to that light green background color. And the reason for that in both cases is that the green line on the market forecast, that's our intermediate line, and remember that's kind of our default mode that we use to set our posture for these videos. The green line has now emerged out of the lower reversal zone. The green line is now at 21.26 and rising. Remember, the lower reversal zone on the market forecast indicator is 20. So in other words, we got up and above 20 here just barely today, and the same thing can be said for the Dow Jones. It's at 22 and rising. So we're back to weekly bullish, not strongly bullish, but weekly bullish postures on all four of our charts. Remember, yesterday the NASDAQ and the Russell 2000 already went to that weekly bullish posture. So the Dow and the S&P 500 joined those two today. But like I mentioned in the intro, at this point, I'm not necessarily going to go wildly bullish. In fact, as I mentioned already, the trade application that we're going to do a little bit later is a bearish trade. And you guys have probably noticed that recently I've been kind of going against the grain to what the posture has been. In other words, as the posture had been bearish for the markets, I had been doing bullish trades up until today, at least in the last couple of weeks. And today, with our posture going back to bullish, I'm actually going to be doing a bearish trade. Now, it doesn't make a lot of sense to go counter trend, so to speak, or counter to whatever your posture setting device is if you are in a strongly trending market. But that is not what I feel like we are in right now. I feel like we are in a slop and chop market where I want to buy the dips and sell the rips. This is not a steady eddy trend like we saw earlier in the summer. This is a different type of a market where sometimes you have to be brave enough to go the opposite direction. And so after a big rally the last 3 days, I think now might be in a time where you start establishing some more of those bearish trades again. Remember that before we had this big decline, I was placing bearish trades on, some of those REITs, some of those healthcare stocks, and that was at a time when it looked like the market was okay. And then as the market has come in, I've been doing a little bit more of those bullish trades. In fact, I had good news on that front. Some of you that watched the video on Thursday when we did Workday as our trade application example as a bullish swing trade to the upside. Today we were able to achieve our maximum price target, and that OCO bracket order was filled, and we were able to take max gain on that. So on Thursday, it didn't look like the markets were going to amount to much, but we've had some rallies since then that have helped. Now that the market has rallied, I'm going to get a little bit more cautious again as we are still kind of underneath that moving average right there. So I think if you were kind of waiting for a moment to kind of reload the gun on the bearish side of the equation, you're in that general vicinity right now. Now, obviously, I have no idea what's going to happen with the debates tonight and how the market's going to react to that tomorrow. But I think if you're kind of measuring your risk versus your reward right now, that this is a time where you've got to be cautious because you've got these lower highs and lower lows that we're dealing with ever since topping out on the S&P 500 on September 2nd. We also are in a choppier time of the year. September and October naturally are. We've got a lot of unknowns directly in front of us, whether it's with coronavirus or the presidential, voting that's going to be taking place up until November. So there's a lot of things that could go wrong. Now, there's a lot of things that could go right as well, so we have to take that into consideration. There's obviously the idea that the first day of the month it tends to be a strong day. So October 1st is just around the corner. It's possible we get an up day there. We're going to embark upon an earnings season here. And it's possible that there's going to be some upside surprises. I'm not sure if I'd be banking on that, considering, a lot of people feel like we've been in an economic recession for the last several months, but anything is possible. And we have to remember that, the stimulus package could come out and surprise a lot of people with its positivity. There could be a lot more, money printing from the Fed that supports the markets. So there's a number of things that we have to be on the lookout for. But right now, just from a technical picture, I feel like with us trading below that falling moving average, but now we've had kind of a reversion to the mean type of a move back to that moving average. Now would be the time, as opposed to several days ago, to put on new bearish trades if that's the direction you want to go. Some of you are going to be comfortable with the idea of never putting bearish trades on, and I don't think that's necessarily the end of the world either. Remember, naturally, stock markets do rise over time, but for those of you that do want to be a little bit more active with your trading, then you've got to pick your spots. And I think right now makes sense to have some bearish trades in your portfolio after we've had this nice rise to get some better pricing on your fills and your executions. So as it stands right now, summary is we have weekly bullish postures according to the market forecast, but we are still below falling moving averages, which is why those moving average tips are all red on all four of our charts. So we're kind of in in no man's land right now, where you could make a case for either the bullish side or the bearish side of the equation. So stay nimble, stay agile out there. This is a choppy market. Let's go ahead and take a look at our next chart setup. And this one will be our 3 green arrows chart setup. So this will be chart 4D. For those of you that are premium members following along at home, we've actually had quite a few folks that have signed up for our premium subscriptions here in the last week or so. And if you're one of those, remember that you can go to our website and go to the, in fact, let me just show you while I'm thinking of it. It's better to see it than just to hear it. So if you are one of our premium members, remember you can go over here to our Tools tab, hover over that Tools tab and click on Premium Resources. Once you're in there, you'll see the tutorial video and all the shared importable links that you can put into your own Thinkorswim platform. So that way you can follow directly along with David and I when you're watching our classes and presentations, because you guys are going to have all the exact same charts that we use. Also, while I'm over here on the internet real quick, just wanted to say thank you to those of you that clicked like for me when I did the video on Thursday over on Twitter. 119 of you did that. I always shoot for getting triple digits, so 100 or more I like, and I really appreciate the extra 19 people beyond the 100 that did it this time around. So make sure we get this full-length video for you here tonight. Remember, if you prefer the abbreviated version of the video where I just give you the 15-minute version, maybe exclude some of the things like the application examples or what have you, but just kind of get you a quick hitter type of a video, then don't click like on Twitter. If it's less than 100, then I'll just do the abbreviated version next time. If it's more than 100, then I'll continue to do the full-length versions of that. So I'll let you guys kind of decide on that. And remember, you can always find the tweet in question pinned to the top of my timeline directly on Twitter, or if you're watching it here on our website at Market Scholars, we have this little Twitter widget that you can click the heart on directly from there. So thanks to those of you that do that each and every time. For David and I, it goes a long way for us to kind of spread the word about our company to others. Also, while I'm over here real quick, just wanted to share with you the most recent updated version of the sector selector that I put out over the weekends. There wasn't a whole lot of change up at the top. You can see that our top three sectors remained the top three. Materials, discretionary, industrials continue to be the leaders from a trending perspective. It was interesting to see that healthcare had a nice little bump higher here week over week. We did see financials really fall apart week over week as well. Many of you remember last week we had that money laundering scandal that was taking place with a lot of the global banks. So I think that kind of added to the pressure of the financials, generally speaking. So pretty much the same strength up at the top that we've been dealing with here in recent market sessions. All right, let's get back over here to the Thinkorswim platform. On this chart 4D, for those of you that are premium members following along at home, remember that when you're looking at the background colors of this particular chart setup, it is telling you whether you have 3 green arrows, 3 red arrows, or a mix of green and red arrows. And if the background color is white, like it is in the case of all of our charts right now, that means that we have a mix of green and red arrows. We had 3 red arrows up until today on the Russell 2000. So I suppose that is a change that I should report to you. Yesterday we had 3 red arrows on the Russell 2000. Today we had enough evidence from the rise of the prior 3 sessions that we saw the MACD histogram go back to a green arrow there. We also saw a green arrow emerge out of the stochastics, but because price is still below the moving average, we don't have that 3rd green arrow yet. But at least a little bit of progress there from the Russell 2000, which had been, somewhat of a laggard here recently. I can't say I'm overly enthusiastic about the candle that we see out of the Russell 2000. If I were to maximize the sell, you can see that this gives you the impression of kind of a hanging man type of a candle there. Remember, the hanging man candle tends to be up at a resistance area. So whether you agree with this is a resistance area or not is up to you. But clearly we struggled to get beyond these highs the last 2 days. And so we'll have to await further evidence starting tomorrow as to whether this is a candle that will push markets back a little bit lower. But again, with that downward trending 30-day moving average and a clearly defined set of lower highs and lower lows, I think the weight of the evidence still suggests that the bears are a bit more in control of the situation over here on the Russell 2000. Remember, those are your small cap companies here in the United States. So anyway, we don't have 3 green arrows, we don't have 3 red arrows, we have a mix of green and red arrows across the board on our 4 major market indices here today. Let's take a look now at the 1040 crossover method. This is chart 4C for those of you that are following along at home. And in this case, not a whole lot to report here. Remember, we don't really have a whole lot of changes on this chart setup naturally anyway, because it's the least sensitive of the charts that we look at. In other words, these are 3-year charts and each one of the candles is 1 length. So we just don't have a lot of switches in posture. The idea behind this chart is to try to capture the major movements in a longer period of time. And I think for the most part, you were able to do that with these charts, with the exception of the Russell 2000. I think the Russell 2000, it would have been hard to make money on the 1040 crossover method over the last 3 years. But the other charts, I think you would have fared a little bit better, because we've largely had a upward trending market, and you can see the background colors of the charts have mostly been green over the 3-year period. So despite some turbulence around things like the coronavirus, and then of course the big sell-off during Christmas time or the holiday season in 2018, with those two exceptions, we've had really robust price action, particularly with something like the NASDAQ, which has had a lot of tech leadership from names like Apple and Microsoft and others. So as it stands right now, all of these charts are still kind of in the bullish position of having their 10-week moving average still above their 40-week moving average, but the one that is pinched the tightest is the Russell 2000 at this point. You can kind of see that showing up down below on the PPO as well. That's the one that's closest to the zero line there. So in other words, if you're placing bets on which of these charts will see a death cross first with the 10 versus the 40-week moving average, it's likely going to be the Russell 2000. Not to say that it will happen, it's just to say that if there are bearish crosses taking place, the Russell 2000 is the one that's closest to having that cross at this moment in time. So it would likely be the first one to go. All right, let's go ahead and now take a look at some 12 grid analysis. One thing I wanted to point out, we don't look at this commodities chart all that much, but I'm going to bring it up here today because I was a little bit surprised to see some of the aggressive behavior in the liquid commodities, especially oil and gas, etc. So in the top rung up here, you're going to see a lot of those. And notice that oil in the form of USO was down 3.45% today. You can see what that candle looks like there, kind of rolling over once again below that falling moving average. Continues to have that strongly bearish intermediate posture, which is at 40 and falling at this point. So things don't look so promising there with oil. But it was really natural gas that kind of caught my eye today. I was surprised to see natural gas, at least according to UNG, which is what we use as our proxy for that from the ETF space, it was down 9.5% today. That's a really ugly move. And you can see that not only was it ugly in percentage, but it was ugly in shape of the candle in the chart as well. In other words, you can see we gapped down from yesterday when we started today's session, and we didn't stabilize. We basically kept on selling off, and effectively closed at the low of the session on UNG. Not only that, but you can see the low of the session ended up being slightly below the low right here on September 17th. So not a good look there. Gap down, close at the low. The closing price is the lowest closing price in a couple of months. And to add a little bit more fuel to that fire, you can see that the moving average has transitioned to red here recently. So price is falling below a downtrending 30-day moving average in this case, in addition to having that strongly bearish posture according to the market forecast with that darker shade of pink there and the intermediate line at 33 and falling. So things not looking so hot there in oil and gas. Gasoline itself, which of course is different than natural gas, but gasoline itself also sold off pretty strongly today, about 4%, but its charting looks quite a bit better. You can see it's actually still retaining its bullish posture at this point, but today was an important day in that it closed back down below its falling moving average. So you'll notice that the 3 days prior to today, gasoline actually was shooting higher. Maybe some optimism around the economy and the hopes that people are going to be driving their cars a little bit more and the demand for gasoline would be there. But today was a give back day and went right back below that moving average again. So I think the chart on gasoline is a little bit more steady, whereas there is definitive bearishness in oil and natural gas at this exact moment in time. Gold, of course, has been a topic that we've been talking a lot about in 2020. So both gold and silver were up today. Let me right click on gold and maximize that chart so you can see it a little bit better. You'll notice that we were kind of trying to hold the line right here. We had a kind of a triple bottom that ultimately failed using that time period of August 12th, maybe again at the bottom of this wick on August 27th, and then again here on September 8th. So there seemed to be some support that was building up from a horizontal perspective at that time. And we were kind of talking about that right here, I remember, after it had bounced, saying, boy, we kind of got saved by the bell on that one, but it'll be interesting to see where we go from this moment, because we also acknowledged that we had lower highs that were being set on gold at the same time we were seeing equal lows. And a lot of times that pressure does end up breaking to the downside, and that is indeed what happened this time around, where we had this gap down from here to here, and then we clearly were trading below that prior horizontal resistance, or actually was support at that time. But the point that I'm trying to make now is that it might ultimately become resistance. That is a theory in technical analysis, that old support becomes new resistance. And so I wanted to point that out, because after gold had sold off so aggressively and clearly breached that horizontal support area, it actually ended up giving us an oversold cluster signal. Notice the blue, the green, and the red lines all in the lower reversal zone on the same day, producing that little green dot on the chart right there. That it tends to be a place that doesn't necessarily suggest that the trend is going to change, but it oftentimes is a place where it suggests that the selling is a bit overdone at that exact moment in time, and there might be a reversion to the mean type of a move. Now you'll notice that the last 4 days since then, that's kind of what we've had, where the pressure, if there is any pressure in the gold chart right now, is to the upside over the last 4 days. However, what I'll be curious about is if it can continue this momentum, or whether it's going to give up the ghost and actually give you another opportunity to go bearish on it. And it's that second alternative there that I'm kind of thinking is going to take place here. Now, as I've stated in these videos before, kind of hope I'm wrong, because I enjoy being bullish on gold more than bearish, personally, to each their own there. But you know, you got to be willing to call them like you see them. And right now, what I see is a situation where you're getting a miniature reversion to the mean type of a move here. And if GLD goes up another day or two and starts hanging out at around this level where it was trading back on the 21st and 22nd, and it looks like it's going to fail there, you know, you've got the pressure on the market in the form of the downward trending 30-day moving average. You can see that we clearly have a strongly bearish posture that we're dealing with here with this dark shade of pink background color. And you have the technical analysis theory that old support becomes new resistance. So I'm going to keep my eye on that, and it is possible that, you know, maybe the next time I do the video, or maybe next week, if it looks like there's a bearish setup there, I might very well do it as our trade application example, because right now it's just looking like gold is just not being supported at this point. It seems like the bears have kind of taken over this chart, unfortunately. All right, let's get on over here to another set of 12 grids. And in this case, we're going to do the asset class 12 grid. So this will be chart 5A. US dollar was down today. So notice down here in the lower left-hand corner, US dollar was down about 0.5%. That might have explained why gold was able to rise today. But again, you're kind of looking at the Rorschach test with those two. Notice that gold has risen the last 3 or 4 days at the same time that the dollar has fallen the last 3 or 4 days. Yet from a longer term time period, the intermediate term to be specific, you have a bullish posture on the dollar despite having fallen the last 4 days, and you have a bearish posture on gold despite having risen the last 4 days. So how this gets resolved, of course, is anybody's guess, but right now, if I were a betting man, I would suggest that the US dollar is going to find some support, and gold is going to meet a little bit of resistance. We'll see if that plays out or not. In terms of other areas that are of interest on these 12 grids here, Be aware that the Treasury yield did fall today, so we are currently at 0.64% on the 10-year Treasury yield here in the United States. That has maybe given a little bit of levity to some bonds out there. It's not the U.S. government bonds that have impressed me here today, but the chart directly to their right, which is the foreign bonds. In this case, we use BNDX as our proxy from an ETF perspective. We've actually had a decent amount of strength right there in the foreign bond market the last 3 or 4 sessions, and we're approaching some of these old highs back at the beginning of August there. And look at the difference in that chart versus the long-term U.S. government bond chart just to the left of it. There we're kind of dealing with maybe mid to lower part of the 3-month range, whereas on foreign bonds we're about ready to break out to the upside. So you don't oftentimes see a big discrepancy in the bond markets, but now appears to be one of those times. So keep your eye on that particular situation there as well. In terms of foreign stock markets now, up at the top you can see that both EFA, which is the developed foreign stocks, and EEM, which is the emerging foreign stocks, both fell today, but neither one of them fell as much as the U.S. market. U.S. market was down 0.5%. Each of those foreign indices were down just a hair. I mean, you could get away with just calling that flat here today. So perhaps a little bit more strength from that perspective overseas. But of course, that does have a tendency to change depending on where we find leadership within the various markets out there. Now, in terms of the different sectors, it was pretty much a bearish day from a sector perspective. So I'm going to pull up 5C here and just show you briefly that the only sector that finished higher today was communications, and it just barely finished higher. It was up 0.1%. All the other sectors were down today. Once again, those lowly energy stocks, oil and gas, getting massacred, down 2.75% today. So it is just consistent bloodbath over there in the oil and gas space, and that's despite having a decent bounce yesterday on the news of that Devon Energy acquisition. And so there has been a little bit of merger and acquisition activity within the oil and gas space now that some of those names are so low and dirt cheap, but it's still not enough to get the entire sector up and running at this point. And of course, today it was probably a victim of what I've already shared with you, which is both oil and gas from a commodities perspective got massacred today. So of course, the producers of those commodities in the form of XLE really struggled here in this particular case. All right, let's get into our trade application example, and I'll show you what I've already done, and a reminder that if you are a premium member, so not a plus member, but a premium member of Market Scholars, I send you guys this information before the market closes. So a reminder that Workday got closed today. This was the trade that I did on Thursday as a OCO, one cancels other bullish swing trading idea. So just wanted to confirm we did get out this morning near the top of that candle right there off of that bounce off of that moving average. So I wanted to go to a different direction rather than Workday, ticker symbol WDAY. I wanted to go to ticker symbol work. I know that can be confusing, but ticker symbol work is Slack Technologies. And as I mentioned in the intro, this went public via direct listing. And there's a lot of chatter about that process right now with Palantir that is going to be going public the same way here later this week. But as I look at this particular chart, Slack Technologies, I'm not exactly enthusiastic by what I see on the chart right now. So what I ended up doing earlier today was selling a bear call spread. And again, if you're a premium member, you would have received that information on our Telegram alert service that you are entitled to. So that gives you a heads up on these trades that I'm doing during this market while it's open, so that way you guys can consider the trades for yourself prior to everybody else that's just simply watching the free YouTube version of the video later that night. So make sure you're taking advantage of those resources if you are a premium member. And if you're not a premium member, I'd encourage you to go over to our pricing tab on our website and check out our services. Anyway, the reason that Slack caught my eye here, first of all, it was kind of in the news regarding the direct listing, and so I just pulled up the chart and I was like, you know what, this actually looks like an interesting bearish trade idea. First of all, as we look at this 3-month chart here on chart 3A, you can see that it's underperforming the S&P 500. So, typically if you're going to be taking a bearish trade, you want relative underperformance versus a benchmark. And clearly the S&P 500 has drifted a bit higher over the last 3 months if you look at this dotted gold line on the chart, whereas this stock's price candles are well below that dotted line. In other words, you did quite poorly if you were an investor in Slack Technologies over the last 3 months. You can see it's actually down 13% over that time period. What also caught my eye in this particular regard is that on this swing trading chart, you'll notice that the background color of the chart went from blue yesterday to light pink here today. And what that signifies is we now have a bearish near-term posture. So on this particular chart for swing trading, we're emphasizing the blue line, not the green line. And in this case, that blue line went to a bearish posture today. So it's somewhat of a fresh trade, I guess you could say. It's not stale. Obviously, you still see that the downward trending 30-day moving average is probably going to end up representing some sort of a resistance point along the way. It doesn't have to, but you can see an example of that a couple of times along the way. Right there, it went up and touched that moving average and bounced right back off of it. Here, it went back up to that moving average and bounced right back off of it. Obviously, here you went well above it, but eventually just kind of stumbled once again. So it kind of feels like this particular stock feels a little bit more comfortable under the moving average than above it. And of course, that would help support a bearish trade idea. Now, the kicker of it all, and the final piece of the puzzle here for me, was that we also have what's known as a bearish near-term divergence. You'll notice down below here, the blue line peaked on September 22nd and then had a slightly lower high here on September 28th. Now the two candles that was associated with is this candle right here on the 22nd and this candle right here on the 28th. In other words, price went up at a time when the indicator went down. The price is kind of masking some of the underlying bearishness. If you're only looking at price by looking at, let's say, the Wall Street Journal quotes, you're probably not recognizing that there's actually something a little bit more sinister taking place below the surface. So in the case of today, what I ended up doing was selling a bear call spread. I sold the November monthly contracts, and I sold the, I believe it was the 30-31. So I sold the 30-31, and so I'm selling the 30 call, and I'm buying the 31 call. That is known as a bear call spread. It's a credit spread, and the goal of that particular trade is to have the security in question, in this case Slack Technologies, stay below your sold strike. In this case, my sold strike was 30, so the bet that I'm making with this particular trade is that Slack will stay below $30 per share on expiration day there in mid-November. And if I'm wildly wrong with that guess, then the purchase of the $31 put, the $31 call along with it, it represents kind of my hedge within the trade, because obviously when you buy a call, you're bullish. So the driver of the trade is the sold call at 30, but if it does explode higher, and let's say it goes all the way up to 36 between now and November, my bought $31 call will hedge me beyond $31. So I'll still lose money on that trade, but I'm just not going to lose incremental amounts of money the higher that it goes. So it's a good defined risk type of a trade in this particular case, and I was able to receive our traditional 30% return on risk there. And again, all these details are there for those of you that are premium members of Market Scholars in the Telegram that I sent out earlier today if you need to check that out. Okay, so that's what I got for you here tonight. Go enjoy the presidential debate here tonight. See if that affects the markets in the morning. David will be back with you tomorrow. But I think the key summary in tonight's video is, yes, it's great that our posture went back to weekly bullish, but be careful trusting that too much because we're still trading below falling moving averages. And so I think it makes sense to have both bullish and bearish trades in this market at this moment in time. It is not a one-sided market we're dealing with. So with that, I want to wish you all the best of success with your trades and your investments. If you got value out of tonight's video, be sure to go over and click like for me on Twitter. Thank you so much. Have a great night. Take care. Bye-bye.